Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm here to help you maximize your cash flow. Today I want to go over an infinite banking family plan, not quite so similar to one that I went over a few videos ago, where I did a family plan for someone with 5 different kids. And what we looked at was premium payments that were even for all of the kids. In this scenario, what you're going to see is we're going to compare a couple of options, but the goal in this one was to weight the premiums based on the kid's age. So what we decided to shoot for was, what is it going to take for max funding of these policies for 10 years and then base premiums after that? And the goal is we want to hit 500,000 or right around it by age 40.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
So this was an interesting challenge and it was kind of fun. I had a whole bunch of different illustrations that I had to play with. I had premiums that I had to adjust to try and get it right, with the goal being $500,000 by age 40 for each of these people. And then we had the remaining amount of a $200,000 annual premium. The remaining amount was going to go to a policy for his spouse. Let's take a look and see how this ended up. So what you're seeing here is we have the insureds is going to be, we have a wife, age 43. We have a bunch of male children and 1 female child. And you can see the ages here. So we've got quite the spectrum. We're going from age 8 to 43. And then we have our premium option. This is premium option 1. And over here we have premium option 2. Premium option 1 is calculated using Guardian's L95 product. Premium option number 2 uses Guardian's L99 product. Other than that, they're designed exactly the same. So this is also a good opportunity to see some of the differences between these two products. Now, L95 means that you're going to pay premiums until age 95. L99 means you're going to pay premiums until age 99. Both policies end up maturing at age 121. So really the only difference is how many years do you plan on paying into it. Now, a lot of times we use L95, and I'm going to do a video showing you the difference between L95 and L99, and we're going to do a few different scenarios looking at those so that you can see the difference. But when we maximize our cash flow with these Guardian policies and we do the most that we can put into them for 7 years and then we turn them into a reduced paid up, the L95 long term produces much better cash values. However, with the same design, if we use the L99 product and we don't do a reduced paid up, we end up with better cash values out of the L99 product. So it's pretty interesting, and this is why it pays to talk to your agent and make sure that they understand whatever your expectation is for this policy. So if you're planning on just doing a short funding period on these policies, mecking out every year, and then turning off those premiums in order to streamline the policy, it works great using that L95 product. However, if you're going to fund it for 20 years or more, then you're probably better off looking at the L99 product for that cash value growth. Anyways, I'll be doing another video on that, comparing those two and the results that you can see. But in the meantime, let's check out this comparison scenario for this family and how these products stack up. So premium option 1, what I did was I went through with each kid first and I figured out how much premium do they need to put in for those first 10 years. Recall these are 1090 design where our base premium is 10% of the overall amount we're going to put in for the first 10 years. So in this case, our base premium for the 8-year-old is going to be $1,725 a year, with the ability to put in $17,250 each year in total premiums, so paid up additions and base premium. Our 13-year-old, $1,975 and $19,750. Remember, these are our columns here. So we've got our premiums in years 11 plus. Column E, we've got our death benefit in year 1. Column F shows us our break-even period. This one's an interesting column because you see quite a bit of difference, even though I've designed these policies exactly the same way. The difference in the break-even period mostly has to do with their age, their health rating. You can see if they're over 18, our break-even period is a little bit shorter with this design. That's because they can qualify for the better health ratings. When you're under 18, our juvenile policies, you automatically get the standard no tobacco rating. You don't get the premium ratings. But at the same time, your kids aren't going to be subjected to medical exams. So they're not going to get their blood drawn and you're not going to have to do a urine test. But when we get younger, it changes a little bit and we can end up with a lower break-even period again. So it's pretty interesting how these work out, and we'll be able to see the difference in both products, what that break-even is. So what I also did was, besides figuring out what the cash value is going to be at age 40, remember we're trying to get to 500,000, I also did in this spreadsheet what the cash value is at year 20, what the cash value is at year 40 for each of these policies as well. And then you can see here, I was able to get them all very close to the 500,000 cash value at age 40. Now, something to keep in mind is these are the projected cash values. These are using the non-guaranteed rates. It's based off of the current dividend rate that Guardian is paying out. So these can and will vary when it comes to actual performance. Now, dividend rates are not guaranteed. They will go up and they will go down, but historically Guardian has always paid out dividends. So when I put these spreadsheets together, I usually don't deal with the guaranteed scenario, because guaranteed scenario assumes no dividends. Well, Guardian's going on 150 plus years of paying dividends. So we're going to be able to assume that they're going to pay out some dividends in the future, at least when we're looking at this. The guarantees are, of course, good to look at and good to consider when we're looking at worst case scenarios with these types of policies. But for this instance, we're going to look at what pays out with the dividends. So column J, this starts premium option 2. I'm going to slide this over a little bit. So column J, premium option 2 is the L99 product. You can see that we've got a little bit different premiums compared to premium option 1. So I had to adjust the death benefit because the cash value would go up too much, and it was kind of a wide variety of who's going to be at 500,000 or close to it. Some were going to be under, some were going to be over. So I had to adjust the premium options in order to get to that target of 500,000 by age 40. So you can see here our death benefits, slight change between column L and column E, slight change for each person. Most of them, the death benefit was adjusted upward, but you can see for these young folks, or at least one of the young folks, we had to adjust it downward. For everybody else, it was able to go higher. Now, the reason for that, you can see we also lowered the premium quite a bit on that person. Well, with that lowered premium, a lower premium leads to a lower death benefit. Then we have our break-even years, very similar to the L95, but you can see it basically adds a year. So this is another one of the drawbacks with the L99 compared to the L95. The L95 gives you the most early cash value between those two products. Important for a lot of our clients. So that's why we write a lot of L95s, but you know, if the early cash value is not quite as important, if you don't need to squeeze every last penny out of that early cash value, the L99 can be a good product if you plan on paying premiums for longer periods. And we have our cash values in year 20, year 40, and then age 40. So it was a lot harder for me to get these right at 500,000. So I didn't quite make it, didn't quite get it to 500,000, but we're very close. So let's look at this comparison. This is what I was able to send to the client in order for them to compare. Ultimately, their goal is to have a fairly consistent result among the kids based on their weight. They knew that the older the kids are, the less opportunity they have for that compounding growth to happen. The younger kids could take advantage of that compounding growth and still end up with really, really well-performing policies. So between the L95 and the L99, for our 8-year-old male child, we had $17,250 premium that they're going to put in for 10 years. After that, drops down to the base premium, $1,725. And we had a $1,975 death benefit. 5-year break even. I should highlight it right there. 5-year break even. And cash values, these are the interesting things. So when we look at the comparison here between L95 and L99, we've got cash value in year 20 for the 8-year-old, $290,000 with premium option 1, $283,000 premium option 2. So this product, the L99, it takes a little bit longer to ramp up. But not only that, we're putting in less money each year. Okay, so we do have to take that into consideration. But ultimately, it does take longer to ramp up. So what we're going to see here is by year 40, they're almost even. We've got 674 and 673.8. So it's very, very close. But while that cash value is very close, you might say, oh, those policies are pretty close in year 40. Remember, one of them is paying $750 less every single year. So ultimately, by year 40, you've had 40 years at $750. That's about $30,000. That's about $30,000 less that has actually been put into the policy. So while it looks like between the two, there's not much difference between premium option 1 and premium option 2, at least for the 8-year-old. When you consider the amount of money that you actually put into the policy, premium option 2 really ends up standing out in this case. Let's look at 13-year-old child. This one's the female. $19,750 is our premiums for option 1. $340,000 cash value in year 20, $800,000 in year 40. And when we go to premium option 2, you can see again, I was able to drop it by $750 right here each year. So we were able to drop it down to $19,000 a year instead of $19,750. Our death benefit stayed the same. Our break even stayed the same. And now our cash values slightly less in year 20, $334 compared to $340. But by year 40, this premium option 2 has actually surpassed premium option 1. So not only did it surpass it by $5,000, but again, we've paid in $750 less every single year. Just realized I made a mistake. It's $750 less for the first 10 years. So that's $7,500 difference. After that 10th year, it's only $75 less. So going back to, let's back up just a little bit, back to the 8-year-old, it wasn't $30,000 less that we put into it. It's $75 less and then another $75 per year for 30 years. So $7,500 for the first 10 years, $75, so $750, $1,500, $2,250. So $2,250 plus $7,500, $9,750. So $9,750 is what we put less in, and we ended up with about the same amounts after 40 years. So it's not a huge difference, but when we're talking about maximizing our cash flow, we're going to maximize our cash flow. So we're looking at the same in this one. So not only are we $5,000 ahead in year 40 with option 2, but we've also put in $9,750 less. And our cash value at age 40 is only slightly less for this child. Moving on, we've got our 15-year-old child. $22,000 was the premium option. This one's interesting because the premium option stayed the same, and the death benefit stayed the same for option 1 and option 2. Let's see how this turned out. We had a break-even year of 7. Death benefit stays the same. Break-even year for the L99, 8 years. So it added a year for this child. Cash value, year 20. We've got $380,000 and $382,000. So in this scenario, our L95 and our L99 have been putting in the same amount of money each year for 20 years. And we are $2,000 ahead with the L99. By year 40, we're now $18,000 ahead. We went from $890 to $908. Okay, and our year 40 was really close to that break-even point between the two. They had almost the same amount of value, 500,000, just over 500,000 on each one. Moving on to our 17-year-old child, you can see we've got 24,500, death benefit $2,030,000. Now this one's interesting because we had the same premium that we were able to do for the option 2 for the L99 product, but the death benefit, I had to step that one up just a little bit. So the L99 product was able to buy an extra $30,000 death benefit for the same amount of premium when we stepped up just 2 more years in age. Our break-even period extended by a year. And how's our cash value? Our cash value in year 20, slightly higher for the L99 product, and about $16,000 higher for cash value in year 40. And by age 40 is about $4,000 higher. And now we have our 20-year-old male child. This is where we can start getting into better health ratings. We've got $27,000 premium, gets him to right at $500,000 at age 40, 6-year break even. How does this compare? We've got a 7-year break even with the L99 product, but cash value by year 20, we're at $5,000 higher in year 20. And by year 40, $36,000 higher. So that makes quite a big difference. We're starting to see where the difference in products and the difference in age make a bigger difference. If we go back and check out, remember, we're shooting for $500,000 by age 40. This is quite a bit different. This is quite a big difference. We've got our 8-year-old male child only needed to put in $17,250 a year for the first 10 years, but our 20-year-old male child needed to put in $27,000 for those first 10 years in order to get to that $500,000 value by age 40. Let's look at the 22-year-old male child. Now we're up to $29,300 in annual premiums. Our death benefit, $21,500. This one's interesting. I had to lower the premiums a bit, about $300 for the premium option 2 in order to get us to that $500,000 by age 40. And our cash value, year 20, we've got about a $5,000 increase, and by year 40, $37,000 increase. So clearly option 2, if we're just looking at the kids, option 2 was the way to go. This client also thought that. They ended up opting for option number 2, and we are currently waiting on underwriting to see how this will all shake out. So we've got the wife is going to make up the difference. So what I did here was I added up all of the premium options. We want a total $200,000, and so the wife gets whatever's left over. So in this case, she gets $60,200 for her benefit, which paid out $2.5 million death benefit. And in this case, in the L99 option, she had a couple thousand extra. Doesn't make a big difference on the death benefit, but it does a little bit, an extra $20,000. Our break-even year, 4 with the L95, and break-even year 5 with the L99. Now, as you get older and your premiums go up, you have these higher premium options that you're putting in, you're going to see a bigger difference between the cash values on the L95 and the L99. In this case, by year 20, she's got an extra $50,000 in this L99 option. Now, she has been putting in an extra $2,000 a year, right? But that's not $50,000 over the course of 20 years. She put in an extra $2,000 for the first 10 years. So that's $20,000. And she put in an extra $200 for the next 10 years after that. So that's only another $2,000. So about $22,000 is what she put in, but the cash value growth is $50,000. So it's a bonus of about $30,000 over what was put into the policies. Now by year 40, bigger difference here. She's about $26,000 that she's put in extra for option number 2. But our cash value difference is $160,000 difference. So quite a bit different. Definitely option 2 ended up being the winner in this scenario. And really it's because what we're planning to do in this plan is to keep paying those premiums, at least at a base level, after we stop putting in the 10 times paid up additions, okay? If the client was going to stop paying those premiums at some point on any of these people, then we would probably give a lot harder look at the L95 product, because if we're gonna do that reduced paid up, it's gonna end up with better returns with the L95. I had fun putting this spreadsheet together. I thought you might enjoy seeing these differences between each of the kids and those two products, the L95 and the L99 of the Guardian product series. If you want to see some more of this, you can check out this video right here, where I do a different family banking plan, and we don't weigh the age differences. We just give everybody the same amount of premium. Or you can check out this other video down here, where I look at utilizing Guardian's index option and see how that affects our cash values.